Sure. I mean, what is your sense of what's happening in markets right now? Because it's contradictory and confusing. At the one end, it seems like India is relatively sheltered from all of the global turmoil, and on the other end, we're not managing to actually pull through with conviction on any of the key indices or even on the broader markets.
Yeah, good morning. What has happened post the RBI, full front loading of rate cuts, both on the CRR as well as the 50 basis point repo rate cut. I mean, that has created an ample ammunition for the markets to go up, and maybe it is going to overshoot fundamentals. Of course, what we have seen over the last 20-21 days is Nifty 50 has been hovering between 2 and 3%. The broader markets have broadly outperformed since the start of this year vis-a-vis the Nifty. Nifty has gone up till yesterday at about 5%. Small cap index is up 14%. Mid cap index is up 11%. So the action definitely remains in the broader markets. The ammunition given by the RBI only helps this cause. I think there's enough liquidity and there's going to be enough appetite for stocks because I believe asset price inflation is part of the course. Credit demand in the system is not going to be enough for the amount of front-loaded liquidity and cost of capital reduction that has happened. Only hitch, and I think this is the only hitch which might prevent the markets from going forward, is your relentless primary issuances, the IPOs, the QIPs, and promoter selling. I mean, that sucks out a lot of liquidity from the markets, and that's the only headwind that you have in the markets. Otherwise, I think the macros, the fundamentals, fourth quarter numbers, etc., have also been pretty decent vis-a-vis expectation. All in all, I think the markets will go up, more bullish than what the scenario was in the previous 3 to 4 months.
Manish, good morning. The skeptic would argue that, I mean, unless this whenever this conflict dies down, hopefully sooner, then it's fine. But until then, it's a scenario that India may not have wanted, right? I mean, higher oil prices, a conflict which typically drives investors away, if you will, and therefore not the best place from a macro perspective to be in. Is there merit in that argument?
Niraj, barring short-term surge in oil prices, the fundamentals of crude oil are definitely bearish. With China slowing down and the US having its own share of problems and probabilities of recession in the current calendar year still ranges at around 40%. Given that backdrop, India gets impacted on account of crude oil prices. You are very right. But, India has stopped importing Iranian oil since 2020. We have substituted that broadly with Russian oil, and we tend to get 8 to 10% discount also on that crude oil. And Saudi Arabia and OPEC is willing to pump in more oil, given the fact that they also have to balance their budgets, etc. So from that point of view, I mean, barring short-term spikes in oil prices, I really don't see that $80 and beyond crude oil prices will sustain in the current scenario. Of course, all bets are off the table. If you're looking at a scenario when many countries are joining this conflict and there's a situation of a World War III or anything of that sort, I really don't see this, hampering India. Of course, sentimentally it's going to be negative, but I think the positives outweigh the negatives just on account of the Iranian and the Israeli conflict per se, on account of oil.
Manish, what are you doing with portfolio right now, right? Because almost everybody that we talk to, and naturally so, is saying that don't look at it top down. You have to approach this market bottom up and maybe spread your risk. Not one stock should be more than 4-5% of the portfolio because you don't know what will hit when. So maybe not a time for concentrated portfolios either. In that scenario, Manish, what is the dominant theme or the dominant pool where you might have the largest overweight on, and why so?
So ever since RBI has given the dole outs in terms of rate cuts, I think 3-4 spaces or even more than that would tend to benefit more, and we are leaning heavily on those spaces. As I said, that I believe there's going to be massive asset price inflation, real estate being one of them, which is going to get positively impacted. Capital market, stock markets, I think will overshoot fundamentals, more like 10% from where we should be. So capital marketplace, all of them should be beneficiaries. Infrastructure, because cost of capital goes down, liquidity is ample, working capital gets positively impacted for infrastructure or companies. Travel, tourism, hotels, QSRs. These are some of the spaces I think is going to get very positively impacted. PSU banks, because their mark to market on the bond portfolio goes up, and they are trading at some ridiculous valuations. And of course, contra buys in pharma and IT. So I think these are some of the places where we are buying individual companies, both in the larger caps as well as in the mid and small caps. But the flavor, I think, is more leaning towards the broader markets, the mid and the small.
Okay, please stay on with us, Manish. This is a NDTV Profit exclusive that we need to talk about. Government is mulling new rules to stop objections to closed insolvency deals after the Supreme Court scrapped the JSW Bhushan power buy. Remember, this was a huge setback. Now the government stepping in is what we're learning. Vishwanath Nair joining for more details.
Right, Tamanna. So discussions are on at the Ministry of Law level at this point in time, and the Ministry of Law is looking at the ramifications and the feasibility of these proposals. But essentially, what are these proposals? What they are saying is that if a promoter wants to object against an approved resolution plan, especially if a plan has been implemented and they want to still object to it, they may need to shell out all the money first. Whatever they have defaulted on, that money needs to be repaid. Only then can they come against any of these approved resolution applicants. The other aspect of this is that rather than unwinding the entire insolvency process, which is what happened in the JSW Bhushan Steel case, 6 years after approval, it was completely unwound. So rather than doing that, these amendments might bring in rules which will say that anybody who's objecting to the resolution plan will probably get a financial reparation if the plan is found to be faulty, rather than upending the entire deal, which is a really problematic situation for anybody in the insolvency proceedings. This happened in the JSW Steel case, and that sort of shook the confidence of a lot of buyers who were looking to come in and invest in companies which were part of the insolvency process. So this seems like a way for the government to step in and try and give more confidence to potential distressed asset buyers, also to plug any kind of loophole in the entire system. But yes, at this point in time, these are being discussed and reviewed. A final call will be taken a little later, but what we're learning is that these are definitely on the table.
Just, Manish, if you have a view on this, because this is a sore point, right? What happened with JSW and Bhushan, and this was a huge push. Our IBC process was a huge reform, especially for companies that are stuck.
Absolutely. I mean, if you have legal issues on settled cases in IBC, then basically we are undoing the entire reform that we have, implemented. Hello?
We can hear you, Manish. Okay, we can hear you. Okay.
Yeah. So I would think that something in this regard is par the course, and if the government is implementing something of this sort, it's likely going to be quite good for the financial system as a whole.
And then therefore ties in with your theme of you being constructive, I believe, on some of the aspects of the NBFCs in the financial space as well, Manish. Okay. Point well noted. Thank you for agreeing to this request today for the interview at such a short notice. Really, really appreciate that, Manish.
Thank you, Nina.
The pleasure is ours. And Vishy, thanks for bringing this story. Important to track and